Well, hello everyone. I'm John Williams, and I want to thank each of you for tuning in to our very first web-based investor update. Today's agenda will be very straightforward. First, I'll perform a very brief investor update. Then I'll move on to discuss some planning ideas and strategies that you might want to be aware of. Before I begin, though, I'd like to take a minute in these unusual times and remind everyone to please stay safe and also, very importantly, please stay positive. Everyone is experiencing challenging and unprecedented times, but as Ralph Waldo Emerson wrote many years ago, the first wealth is your health. Now, before I begin presentations, I always find it's important to review there are 5 key areas of financial planning. Number 1, preservation planning, retirement planning, tax planning, estate planning, and also investment planning. And even though today's presentation will be mostly about the equity markets, as a comprehensive financial planning firm, you know we always try to consider the impact of any recommendation we make, not just on one of these areas, but on all of these areas for our clients. What if I were to have told you that there was going to be a global recession coming? The U.S. might even play a role in starting that recession. There would be a trade war with China. The president would be impeached. And to top it all off, the Middle East would fire rockets at our U.S. military bases. How many of you think you would have thought the market would actually go up based on all that bad news? Probably not many. That's exactly what happened, though, in 2019. Last year was a very healthy year for investors, and 2020 started out on a very positive note as well. As we all know, though, in mid-February, after making all-time highs, things changed very quickly. A silent but deadly virus quickly infected the 11-year-old bull market we had all enjoyed. And after that strong year in 2019 and a strong start to 2020, in a matter of days, the S&P fell from its 52-week high to its 52-week low. You know, a lot of people say that knowledge is power, so I just want to quickly examine a little bit of data. You know, after the 11-year bull market, we are now in, or we were in, depending on the day of the week you look at it, a bear market. A bear market is defined as one that falls at least 20% from its 52-week high. Now, bear markets have come and gone many, many times. Historically, bear markets have been part of long-term investors' experience. But since we have, or at the moment had, entered into bear market territory, it might be helpful to review some information about these bear markets. There's 3 different basic types. There's a structural bear market, there's a cyclical bear market, then there's also one that's event-driven. Structural bear market is one that comes about because of imbalances of some kind, maybe a financial bubble. That was the case in 2008 and many years ago in 1929. Cyclical bear markets are more classic. They're typically a function of the ongoing economic cycle. They're marked by rising interest rates, impending recessions, and declines in profits. An event-driven bear market typically are created by a one-time event, maybe a war, oil price shocks, or here lately, the most recent one is the sudden viral pandemic, COVID-19. Like I say, we were or are in an event-driven bear market. Now, these are the bear markets that are the most difficult, if not impossible, to forecast or even navigate. COVID-19 created the first of its kind bear market. This is the first one caused by a virus. We have had event-driven bear markets in the past, but none were created by a viral pandemic. Looking at the government, after lowering the federal funds rate by 0.5% between its regularly scheduled meetings as a response to the virus, the Federal Reserve again cut interest rates in mid-March by another 1%. The all-time low for the Fed funds rate is effectively 0. The Fed has only lowered rates to that range twice, once in 2008's financial crisis, and then again in March of this year. The U.S. government has also responded by trying to prevent some of the threat of a recession and help businesses as well. They've passed several bills, including the $2.2 trillion CARES Act, that stands for the Coronavirus Aid, Relief, and Economic Security Act. This emergency relief package is the largest economic relief package in our history. Now, if all this wasn't enough, in the midst of all this, Saudi Arabia and Russia decided to start a price war in oil. On March the 7th, they decided to start a price war, and that severely began to affect the energy industry. Oil prices saw one of the worst months and quarters in oil price history, going down over 50%. With energy companies and oil still being a big contributing factor to our overall economy, oil prices added to equity markets' volatility. Moving on, as many of you know, a bad decision can be harmful. As this chart shows, the 6 biggest point declines and the 6 biggest point increases in the Dow Jones Industrial Average all came within days of each other. Did you know on March the 12th, the Dow fell over 9%? Had someone have sold and missed the next day, it went up 9%. This level of volatility is unprecedented, and therefore even the savviest of investors need to proceed with caution. The volatility and turbulence of this situation has caused even some of the most seasoned investors to become a little bit skittish. In March, legendary investor Warren Buffett said he hadn't seen anything like the coronavirus pandemic. Of course, no one else has either, Warren. A company called Bespoke noted that the average stock in his top holding was down 37% on March 24th from their February highs. Perhaps the most important thing I think to take away from this is that just like everybody else, his portfolio has not been immune to all this volatility. This may be a good time to point out and recall one of his most famous quotes, which is, "The stock market is a great device for transferring money from the impatient to the patient." Thank you, Warren. How should an investor approach 2020? Well, we advocate being prepared rather than being scared. How should you move forward? One of the things we try to do is to look at all situations and guide our clients with ideas. Even a treacherous downfall can potentially have some opportunities, so I want to take a second and review a few of them. First, thinking long term is still the way to look at the equity markets. Typically, the most successful investors think and act for the long term. You know, it's near impossible to predict exact market movements. However, you can prepare. No one likes declines, but from a tax standpoint, potentially they can be helpful. A tax swap is a strategy that involves selling an investment that has losses and replacing it with a similar, but not identical, investment. The tax loss can then be used to offset gains, or it can be used by banking it for the future to help lower your taxes. There are some basic rules that need to be understood, such as the wash sale rule. So if this is a strategy that you think you'd like to discuss, please just give us a call. Also, maintaining a properly designed and well-diversified portfolio, as always, is important. We think this could be a good time to consider any rebalancing that may need to be performed. So what we're doing is we are looking for a window to consider doing rebalancing. Also, the required minimum distributions that are required from retirement accounts for 2020 have been waived for some retirement accounts. Some investors may not need to take distributions from their retirement account at this time. If you're comfortable with suspending distributions and looking for a potentially better time to take them, please call my office and we can see if this strategy works for your personal situation. Also, although they can be complicated, there are many reasons to consider Roth IRA conversions during a time like this. These would include, depending on who wins the presidential election later this year and how much the government injects into this stimulus package, there is a chance that for some investors at least, tax brackets may increase in the future. Also, for many retirement accounts with equities, those equity values are down a little bit. This can create opportunities, especially for those investors currently in the 12, 22, and even the 24% bracket, in our opinion. Another reason to think about the pros and cons of Roth conversions is the new Secure Act, that it has changed a lot of rules concerning inherited IRAs. As a reminder, in December, a piece of major legislation known as the Secure Act was signed into law. This act brings massive changes for those of us who have retirement accounts. While I'm not reviewing the Secure Act today, it has a new 10-year rule that now says most inheritors can no longer stretch out their inherited IRAs and the taxes that go with them over their lifetime. Now, they need to plan to take the money out and pay all the taxes within 10 years of the date of the original owner's death. That means it's a good idea to review your retirement money and look into the family tax management of you and your beneficiaries. Moving on, the deadline for tax filing in 2019 has been officially changed to July 15th of 2020 for your federal taxes. The deadline for making 2019 IRA and health savings account contributions is also moved to July 15th of this year. Deadlines for contributions on any workplace savings plans has not changed at this point. Please also check with your state for any changes to state filing deadlines because they may have not have changed like the federal deadlines did. Equity market volatility is also back, and as we know, that can be very scary. That's why we have been saying proceed with caution for quite some time. By the way, fear sells, and the media magnification of the current crisis is putting major emotional strain on a lot of viewers. During these times, it may be prudent to resist the temptation to watch too many news reports and obsessively watching your portfolio's performance. Sometimes the more information you have in front of you, the more likely you could make a decision that deviates from your long-term strategy. Adhering to a good long-term investment plan often requires taking the news with a grain of salt and putting the impromptu advice of others on the back burner. Remember, panic and bad decisions can potentially cause more financial harm for investors than a virus or the downturn itself. As a recap, what are some of the key takeaways for investors? Well, 2019 produced very strong returns for equity investors. Extreme volatility, obviously, has emerged. Your health is a top priority. Continue to focus on your personal goals and, of course, call us with any concerns you may have. What can you expect from us? As always, you can expect regular communication, frequent discussions, and you can expect that we are constantly reviewing economic, tax, estate, and investment issues for our clients. Remember, your health and your well-being is our highest priority. And I want to take this moment to say thank you. Thank you very much for the trust and the confidence that you have placed in us. By the way, we would love to help others just like you in 2020. In fact, I would be honored if you would add a friend or two to our mailing list so they can benefit from all the information that you know that we put out on a regular basis. In 1989, Ronald Reagan referred to America as a shiny city on a hill. He said, quote, "In my mind, it was a tall, proud city, built on rocks, stronger than oceans, windswept, God-blessed, and teeming with people of all kinds living in harmony and peace. A city with free ports that hummed with commerce and creativity." End quote. In closing, I want to say, I still believe we are that shining city on a hill, and we are all in this together and together we will all get through this. Please stay safe. Call us with any questions. Thank you very much.